Look, be honest for a second. Have you ever opened your investing app, stared at your portfolio, and thought, why am I doing all this work and still barely beating my savings account? Because I've been there. You read Reddit threads, you watch finance TikToks, you follow Twitter accounts that swear they've cracked the code, you buy one stock because someone said it's the next Tesla, you sell another because the market dipped 3% and your stomach dropped 30%, and at the end of the year, you look at your returns and think, wait, the S&P 500 did better than me, and all I did was stress. If that sounds even remotely familiar, congratulations, you're normal. And also, you're exactly who this video is for, because today, I want to show you the lazy way to beat about 90% of investors, not by working harder, not by timing the market, not by finding secret stocks, but by doing significantly less. And yeah, that sounds fake, but it's not. Let's talk. My name is Eddie, and I spend way too much time thinking about money, investing, and why smart people make absolutely terrible financial decisions. If you're someone who wants to grow your wealth but feels overwhelmed, confused, or stuck doing everything right and still not getting ahead, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Here's the thing. Most people think beating the market requires intelligence, effort, and constant action. But in reality, the people who win long-term are usually the ones who are boring, consistent, and honestly, kind of lazy. And today, I'm going to show you why most investors lose, even smart ones, the shockingly simple strategy that quietly beats them, the psychology traps that sabotage returns, and exactly how you can apply this starting today. No hype, no day trading, no crypto moon predictions, just math, psychology, and common sense, the kind nobody talks about. Let's start with a truth that makes a lot of people uncomfortable. Look, most people assume bad investors are just dumb or reckless, but that's not actually true. Most bad investors are educated, motivated, trying their best, and actively paying attention, which, ironically, is exactly why they lose. Let me hit you with a stat that changed how I think about investing forever. According to Dalbar's quantitative analysis of investor behavior, the average investor underperforms the market by 4 to 6% per year over long periods. Let that sink in. If the market returns about 10% annually, the average investor walks away with like 4 to 6%. That difference sounds small until you see what it does over time. Let's do the math. If you invest $10,000 and earn 10% annually for 30 years, you end up with about $174,000. You invest 5% annually for 30 years, you end up with about $43,000. Same money, same time. One investor did nothing special, the other tried really hard. That's a $131,000 difference just from behavior. Not intelligence, not stock-picking skill, not insider info. Behavior. And here's what most people don't realize. The biggest enemy to your wealth is not the market. It's you. Not emotionally, mathematically. Now, you might be thinking, okay, but I'm different. I research, I follow earnings, I'm not emotional. Look, I love that confidence, but the data does not care. According to SPIVA reports, over a 20-year period, more than 90% of professional fund managers failed to beat the market. Let me repeat that. These are people with Ivy League degrees, teams of analysts, Bloomberg terminals, inside access to management calls, and still they lose to a dumb index fund. And if you think you're going to outperform people who literally do this for a living with better tools and more information, look, I'm not saying you can't. I'm saying statistically, you probably won't. And this is where it gets really interesting, because most people hear that and think, well, that sucks. Guess I'm doomed. But actually, this is amazing news, because it means the winning strategy is not complicated. It's not technical. It's not hidden. It's just boring. And boring works. All right, here's the lazy way to beat most investors. Buy the entire market. Keep buying consistently. Don't sell when things get scary. wait. That's it. That's the whole strategy. And yeah, that sounds too simple, so let's unpack why this works. Instead of trying to guess which stocks will outperform, you just own everything. Big companies, small companies, tech, healthcare, energy, international. You capture global economic growth instead of betting on individual winners. Historically, the global stock market has returned about 9 to 10% annually over long periods. Not every year, not smoothly, but on average. Which means if you just buy a low-cost total market index fund, add money every month, don't touch it, you're already outperforming most retail investors, most hedge funds, most financial professionals, not because you're smarter, but because you're calmer, and calm beats clever. Here's what most people don't realize. In investing, activity is usually the enemy of returns. There's a famous study by Fidelity where they looked at which accounts performed best over time. You know who won? Dead people. Seriously, the best performing accounts were either investors who forgot they had accounts or investors who literally passed away because they didn't trade, they didn't panic sell, they didn't chase trends, they just held. And this is where psychology comes in. Your brain is wired to fear losses more than it enjoys gains, react emotionally to short-term noise, overestimate your own skill, follow crowds during bubbles and crashes, which means your instincts, the same instincts that help you survive, are terrible for investing. Let me give you a real example. Imagine two people. Let's call them Sarah and Mike. Sarah is a lazy investor. Mike is an active investor. Both start at age 25. Both invest $500 per month. Both invest for 30 years. Sarah buys a total market index fund, rebalances once a year, never checks financial news, doesn't touch her portfolio. Mike tries to time the market, rotates sectors, follows hot stocks, panic sells during crashes, buys back in later. Now let's assume Sarah earns the market average of 9.5%. Mike underperforms by just 3%, earning 6.5%. That doesn't sound like much, but here's the math. After 30 years, Sarah ends with about $1 million. Mike ends with about $560,000. Same income, same effort, same starting point. One just did less. And here's the kicker. Mike worked harder. He read more, he stressed more, he stayed informed, and still lost. This is where it gets really interesting. The biggest edge in investing isn't intelligence, it's temperament.
Now, you might be thinking, okay, Eddie, but why do people keep doing this if it doesn't work? Great question. Because the market doesn't reward effort, it rewards patience. And patience feels like laziness. It feels irresponsible. It feels like you're not doing enough. And psychologically, we hate that. Let me break down the 3 biggest mental traps that destroy investor returns. Trap number 1, action bias. Humans are wired to believe that action is better than inaction. If your portfolio drops 20%, doing nothing feels irresponsible. Selling feels productive. But most of the time, selling locks in losses, and buying back later locks in higher prices. Here's a stat from JP Morgan. Missing just the 10 best days in the market over a 20-year period can cut your returns in half. And guess what? Those best days almost always happen right after the worst days, which means the people who panic sell at the bottom and wait for things to feel safe again miss the recovery every single time. Trap number 2, overconfidence. Most people think they're above average drivers, which is mathematically impossible. Same with investors. We believe we're smarter than average. We spot patterns others miss. We know when to buy and sell, but the data says otherwise. Professional fund managers with more experience and better tools still lose, which means your chances of consistently beating them are not great. This isn't an insult, it's just probability. Trap number 3, loss aversion. Psychologists Daniel Kahneman and Amos Tversky found that people feel the pain of losses about twice as strongly as the pleasure of gains, which means a 20% drop hurts more than a 20% gain feels good. You're more likely to sell after losses than hold. You make emotionally driven decisions, not rational ones. This is why people panic sell during crashes and then hesitate to buy back in when prices are low. Your brain is trying to protect you, but it's sabotaging your wealth. Here's what most people don't realize. The market doesn't reward bravery, it rewards stubbornness. Not stubbornness about opinions, stubbornness about process. The people who win long-term are the ones who say, I don't care what the news says. I don't care what Reddit says. I don't care what my coworker says. I'm sticking to my plan. And this works because markets trend upward over time. Businesses grow. Innovation compounds. Productivity improves. Inflation pushes asset prices higher. Not smoothly, not predictably, but consistently over decades. So instead of trying to predict the future, you position yourself to benefit no matter what happens. That's the lazy way. And ironically, it's the hardest way emotionally. Let's get super practical. Imagine you're 25 years old. You invest $500 per month into a total market index fund, earning an average of 9% annually. By age 65, you'd have about $1.3 million. Not because you're rich, not because you're brilliant, not because you timed anything, but because you showed up consistently, you let compound interest work, and you didn't interrupt it. Now let's compare that to someone who waits until 35. Same monthly investment, same returns. They end up with about $600,000. Still great, but literally half as much. Why? Because compound interest doesn't grow linearly, it grows exponentially, and time is the multiplier. Here's the thing. Most people don't lose because they pick bad investments. They lose because they start late, panic early, and quit often.
Now, you might be thinking, okay, Eddie, but what about crashes? What about recessions? What about 2008? Great, let's talk about that. In 2008, the market dropped about 50%. Terrifying. People lost jobs, homes were foreclosed, retirement accounts were cut in half. It was brutal. But here's what most people forget. By 2013, the market had fully recovered, and by 2020, it had more than doubled from the bottom, which means if you panicked and sold in 2009, you locked in losses. If you stayed invested, or better yet, kept buying, you massively benefited. Let me put numbers on this. Say you had $100,000 in 2007. It drops to $50,000 in 2009. You panic and sell. You now have $50,000. But if you stayed invested, by 2020, that $100,000 would have grown to over $300,000. Same market, same crash, different behavior. $250,000 difference, purely psychological. This is where it gets really interesting. Market crashes don't destroy wealth. Investor reactions do. All right, let's get tactical. Here's the exact lazy investing system that beats most people. No hype, no guessing, no stress. Step 1. Automate your investing. Set up automatic contributions. Every paycheck, every month, no decisions. This removes emotion. It removes procrastination. It removes market timing. You're buying whether the market is up, down, or sideways. This is called dollar cost averaging, and it works because you buy more shares when prices are low, you buy fewer when prices are high, you avoid trying to time bottoms and tops. Most people wait for the right time to invest. Spoiler, it never feels like the right time. Step 2. Buy broad, low-cost index funds. You want total stock market exposure, global diversification, ultra-low fees. For example, a total U.S. market fund, a total international fund, maybe a bond fund depending on age and risk tolerance. That's it. Not 47 stocks, not crypto bets, not meme trades, just broad exposure to human productivity. And this matters because fees compound in reverse. A 1% annual fee can cost you hundreds of thousands of dollars over your lifetime. Low-cost funds quietly outperform expensive ones, not because they're smarter, but because they don't siphon off your returns. Step 3. Ignore the news. Financial news is entertainment, not education. Its job is to capture attention, create urgency, trigger emotion, not to make you wealthy. The market goes up and down constantly, but the media only screams when things go wrong, which trains you to associate investing with danger. Here's what most people don't realize. If you invested in the S&P 500 at literally the worst possible moments, right before crashes, historically, you'd still make money over long periods, because time in the market beats timing the market. Every single time. Step 4. Rebalance once per year. Once a year, check your allocations, adjust back to your target percentages. That's it. Not daily, not weekly, not monthly. Annual rebalancing forces you to sell what's grown too much, buy what's underperformed, which is the opposite of what emotions tell you to do. Emotion says, buy what's hot. Rebalancing says, buy what's cheap, and cheap beats trendy. Step 5. Don't touch it. This is the hardest part. Do nothing. No panic selling, no trend chasing, no revenge trading, no just this one stock. Just wait. And I know that sounds boring, but boring is how wealth is built. Here's the thing. We've been conditioned to believe that effort equals reward. In school, more studying equals better grades. In work, more hours equals more pay. In fitness, more training equals better results. So naturally, we assume more effort in investing equals better returns. But investing is one of the few areas in life where that logic breaks. In investing, more trading equals worse performance. More emotion equals worse performance. More news consumption equals worse performance. Less is really more. This is why the best investors in history, like Warren Buffett, emphasize patience, long-term thinking, simplicity, discipline, not genius stock picks, not market timing, not complexity. Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient. Not the smartest, not the hardest working, the patient." Now, you might be thinking, Objection 1, but what if the market crashes right after I invest? It might, and that's fine. Short-term drops don't matter if your time horizon is long. If anything, crashes are good for new investors because you're buying assets at lower prices. Your future returns improve. Crashes are bad only if you sell. Objection 2, but what about inflation? Stocks historically outpace inflation over long periods. In fact, equities are one of the best inflation hedges because companies raise prices as inflation rises, which means profits rise, which means stock prices rise. Cash loses value. Productive assets grow. Objection 3, but I want to beat the market, not just match it. Look, I get it. Everyone wants alpha, but here's what most people don't realize. Matching the market already beats most investors. If 90% of people underperform, simply getting market returns puts you in the top decile, and once you account for taxes, fees, mistakes, emotional errors, index investing often beats even successful active investors. So if your goal is wealth, not ego, boring wins. Objection 4, but I like researching stocks. That's fine. If it's entertainment, go for it, but treat it like gambling, not retirement planning. Put 90 to 95% into boring long-term investments. Use 5 to 10% as fun money. That way, you scratch the itch, you protect your future, and your financial life isn't held hostage by one bad trade. Let's zoom out. If you invest $500 a month for 40 years at 9% annually,
You contribute $240,000. Your ending balance, about $1.9 million, which means over $1.6 million came from growth, not effort, not hustle, not intelligence, not perfect decisions, just time. Now, imagine you panic sell during 2 major crashes and miss the recoveries. Your average return drops to maybe 6%. Now your ending balance is around $930,000. Same contributions, same time, nearly $1 million less just from behavior. This is why investing isn't a math problem, it's a psychology problem.
Here's something Wall Street doesn't like talking about. Complexity sells. Simple doesn't. A fund manager saying, "We own everything and wait," doesn't sound impressive, but someone saying, "We use proprietary algorithms and macroeconomic forecasting models to dynamically allocate capital across sectors," sounds brilliant, even if it underperforms. Humans associate complexity with competence, but in investing, complexity usually just means higher fees, more trading, more mistakes, worse outcomes. Here's what most people don't realize. You don't need a complex strategy. You need a robust one. Robust means works across different environments, doesn't rely on prediction, survives human error, functions even when you're emotional. Index investing is robust. Stock picking is fragile. One bad decision can wipe out years of gains. One emotional panic can derail your entire plan. Robust systems win. Let's talk mindset. Lazy investors think in decades, not days. Systems, not predictions. Behavior, not brilliance. They don't ask, "What will this stock do next month?" They ask, "How do I set up a system that works even when I'm distracted, emotional, tired, or busy?" They design their finances for real life, imperfect behavior, human psychology, not idealized discipline. Because motivation fades, willpower fails, life gets busy, systems endure. Let me tell you about a guy I'll call Jason. Jason started investing in his mid-20s. He was smart, he read books, he followed markets, but he also tried to time recessions, chased hot stocks, sold during downturns, bought during rallies. Over 15 years, he invested about $150,000. His ending balance? Around $190,000. Not terrible, but not great. Meanwhile, his coworker, let's call her Emily, did this. Invested into a target date index fund, every paycheck, never changed it, never checked it. Over the same 15 years, she invested about $150,000. Her ending balance? Around $350,000. Same income, same job, same market, different behavior. Jason worked harder. Emily worked smarter by not working. That's the lazy advantage. Now, you might be thinking, "Okay, Eddie, this all makes sense, but why do people still mess it up?" Because humans crave control. Humans hate uncertainty. Humans overreact to short-term noise. Humans want excitement. And boring investing feels like you're not in control, you're missing opportunities, you're not optimizing, you're being lazy. But in reality, you're being strategic. You're choosing predictability over excitement, probability over possibility, wealth over entertainment, and that's rare, which is why it works.
Let me summarize the lazy way to beat 90% of investors into 5 rules. Rule number 1, own everything. Don't try to guess winners. Buy the market. Let capitalism work for you. Rule number 2, automate contributions. Remove choice. Remove emotion. Remove procrastination. Consistency beats intelligence. Rule number 3, minimize fees. Every dollar lost to fees is a dollar that can't compound. Low-cost funds quietly win. Rule number 4, ignore short-term noise. Markets move daily. Wealth is built over decades. Don't confuse motion with progress. Rule number 5, never panic sell. Your worst financial decisions will feel emotionally justified in the moment. They will also be mathematically disastrous. Commit in advance to staying invested. Here's the part nobody talks about. Lazy investing doesn't just make you richer, it makes you calmer. Because you're not glued to charts, you're not stressed about headlines, you're not obsessing over trades, you're not second-guessing decisions. You know, my system works over time. So instead of worrying about your portfolio, you focus on your career, your health, your relationships, your life. Money becomes a tool, not a source of stress. And ironically, that peace of mind is often worth more than the returns themselves. All right, let's make this actionable. Here's exactly what you can do starting today. Step 1. Open a brokerage or retirement account. If you don't have one, open a brokerage account, open a Roth IRA, or use your employer's 401k. Tax-advantaged accounts are powerful. Use them. Step 2. Choose simple index funds. Look for total market index funds, international index funds, low expense ratios, under 0.10% ideally. If you want ultra simple, a single target date fund works great. Step 3. Automate monthly contributions. Pick an amount you can afford. Even $100 a month works. The key is consistency greater than amount. Start small, increase over time. Step 4. Commit to a long-term time horizon. Write this somewhere. I will not touch this money for at least 10 to 20 years unless there's a true emergency. This pre-commitment protects you from future emotional mistakes. Step 5. Delete your investing app. I'm serious. Check once a quarter at most. The less you see short-term fluctuations, the less likely you are to sabotage yourself. Let me reset expectations. Lazy investing does not make you rich overnight. It makes you wealthy slowly. And that's actually better because it's sustainable, it's repeatable, it doesn't rely on luck, it doesn't break under stress. You won't wake up to 10x returns, but you will wake up in 20 years to financial freedom, security, options, peace, and that's the real flex. Here's what most people don't realize. The biggest risk to your financial future is not the market, it's your own behavior. Not saving enough, not investing early, panic selling, chasing trends, overtrading, overconfidence, fear, greed. But the beautiful thing is, you don't need to fix the market. You just need to fix your process. And the laziest process is the best one. Ending. Motivation plus call to action. Look, you don't need to be smarter than Wall Street. You don't need to predict recessions. You don't need secret stocks. You don't need to hustle harder. You just need a simple plan, a long time horizon, and the discipline to do nothing when your emotions scream at you to do something. That's it. That's the lazy way to beat 90% of investors. Not because you're lazy, but because you're strategic. So here's your challenge. This week, set up or review your investing accounts, automate contributions, simplify your portfolio, and commit to staying invested for the long term. If this video helped you, hit the thumbs up. It genuinely helps the channel. And if you want more content breaking down money, investing, and psychology in a way that actually makes sense, hit subscribe. Because the goal isn't just to make money, it's to build a life where money stops stressing you out. And the best way to do that is by doing less, better, for longer. I'll see you in the next one.